So with Chase Bank ending its no-doc funding program, American Express seems to be doing more financial reviews than ever. Banking rates overall are still high, and banks seem to be tightening up more than ever the last year and a half or so, since rates have been up and the economic circumstances have become less certain. With these shifts in the economy and the way they're affecting the lending market, we need to discuss the value of low to no doc lending. We need to discuss the alternatives that are available with big banks and other super regional banks starting to clam up on their funding programs. Talk about the overall opportunities that are still out there to pursue that will give value to pursuing low to no doc funding programs. And then we're going to overall wrap up with alternatives on where to get those funding options still and some final thoughts. This is JP from Blueprint for Prosperity Network, providing you with the information you need to master your banking relationships and to master and maximize your borrowing capacity so you can customize your blueprint for prosperity. So as I've covered in recent videos, Chase Bank has completely scrapped this no-doc funding program. For those of you who may not have been aware or have maybe a little leery of what you saw on social media around this funding program, Chase Bank essentially rolled out in a very brief window of time a no-doc funding program that would allow you to meet a certain criteria and potentially get reviewed and potentially approved for lending options that they may have had on the table without having to provide documentation. Some of those criteria were being at least a year or more in business, 680 to 700 FICO score plus with no negative items, having an existing banking relationship during that year or so of business, with a few other things in the pot, of course, to consider you in that lending and that underwriting process and in that lending approval process. So this could have been anything from business credit cards, lines of credit, installment loans, etc. This was a $250,000 maximum exposure limit for Chase Bank at the time. It was rolled out late 2023 and scrapped by late 2024. We've also been hearing various data points showing that American Express has been doing a ton of financial reviews on a lot of its existing clients that have been functioning in what they see as a little bit of leery or showing more risk in their giving profiles. So we know that big banks, these larger financial institutions, are getting a little leery. And we know that there's a lot of stress and strain on the banking system. As I mentioned in the intro, interest rates are still relatively high given the last 20 years or so. This isn't just about us borrowing money, but it's also the pressure on financial institutions with rates being higher. You have to understand, banks have molded their entire business model in the last 10 or 15 years around easy money and low interest rates. So with COVID coming along, creating an environment where you had even easier money and lower interest rates, now you have a rapid change in 2022 where inflation had to be acknowledged finally by the Federal Reserve, and they had to start jacking rates up in order to stop what was becoming really intense levels of inflation. This put a lot of pressure on the banking sector. A lot of people aren't talking about it. But again, as I mentioned before, we've had two significant bank failures in 2023 alone. Kind of got swept under the rug, but the reality of it is a lot of pressure on banks, especially those, smaller regional and super regional financial institutions that are exposed to commercial real estate and other parts of the financial markets where higher rates are putting pressure on them. So banks are tightening up. They can't take the level of risk and they can't expose themselves to that level of risk that they were once doing a little bit after COVID and pre-COVID. So with that having been said, the next thing we need to consider, what opportunities are out there at the time of this recording in 2025 and possibly beyond. We know that there's great financial opportunities when it comes to investing in real estate. That's kind of always in the market. It's just a matter of where those opportunities may be. Right now, residential housing is still relatively hot. Many people believe the biggest real estate boom or crisis to come that will create a boom is in the commercial real estate sector, where there's going to be a lot of syndications falling apart because interest rates are higher than normal, and commercial real estate doesn't have 30-year fixed year debt. So that basically means they're in a situation where debt is being, refinanced at 3, 5, and 7 year periods. So syndications that may have been put together in 2019, 2020 at 2, 3, 4% interest rates, whatever the case may be, are now doubling those interest rates a few years later and messing up the numbers for those deals. So a lot of people believe there's going to be a ton of commercial opportunities, apartment complexes, and various other forms of syndications, office buildings, etc., that can come on the market. We know general business itself is also always on the table. Just starting your mom and pop business in your given environment, community, or broadening out, something that you could be offering to a broader marketplace. At the end of the day, we know business is always on the table. It's literally the backbone of our economy. So when it comes to low and no doc funding opportunities, the value of that comes in because many of us don't have a ton of assets or financial resources to access traditional and conventional forms of capital, where you usually need 2 or more years in business, 2 or more years in proven financials, 2 or more years in banking relationships, almost flawless credit, most times collateral. There's a whole litany of things that you normally need to access quality funding in the conventional methods. And so now that arena has shifted, the environment has shifted, low to no doc was once attractive in the last 10 or so years. It really got traction on the internet, late 2010s. That became a thing because so many people, so many of us, started to get access to financial resources by just leaning on one strong suit we may have: cash flow, good personal credit, etc. These were things that allowed us to get our foot in the door, get the initial capital we need to start that small real estate portfolio, to start that small business, to grow and expand that existing small business that had been bottlenecked before. So low doc to no doc funding was really the gateway to financial growth and opportunity for a lot of us in this economic system. It's just the reality of a lot of people don't always understand why, credit card strategies and creative finance strategies even exist and why people would take those risks in the first place. Many of us just don't have the ability to walk into a mainstream financial institution, especially a Bank of America, Chase Bank, Wells Fargo, and get access to their conventional funding tools. So when these programs become available, these creative financing and backdoor funding programs become available, obviously they're going to be enticing because many of us want access to these financial opportunities, these business and investment opportunities, franchise opportunities. We want access to these things, government contracts. We want access to them too. We may have the talent, we may have the skills, we may have the resume, but a lot of times we don't have the capital. We don't have the ability to fund these projects, to get everything off the ground, to get the initial materials, buy that initial first property and fix it up, renovate it, refinance it, turn it over and get the equity out and move on to the next property. We don't have that if we don't have this pristine personal and business financial, packet to provide to the bank for underwriting. So low to no doc funding has a place in the marketplace. That's just the reality of it. And with Chase Bank, American Express, and some of these large institutions scrapping out on these things, or at least backing out at the time, with the economic uncertainties that have come with the new political environment, they really haven't stabilized out since COVID, to be completely honest. And with the interest rate changes that we've experienced in the last 5 years, which have been significant fluctuations to the lowest rates that we've seen in the country's history to the highest rates we've seen in over 20 years, all in the span of a couple years. A lot of moving parts. So if you're looking to run some kind of, solopreneur career, if you're looking to launch, grow, or scale a business, it's tough out here if you're just working class or Main Street America to get access to those resources. So when these opportunities come around where you might be able to go to Chase Bank and get $50, $75, $100,000 in business credit cards, or a combination of business credit cards and lines of credit with low to no documentation, with just bringing your decent credit to the table, starting a small banking relationship and setting your business entity up properly, that's appealing, that's attractive. So, where are the alternatives at this point in time? These programs have been either scrapped, put on the shelf, or they've been pulled back on in a way where they're no longer accessible the way they were. So as you saw in the thumbnail that I put, one of my pioneers commented on a previous video. Look, the reality is banks are going back to their core clientele base that their business model was built around. What that basically means is when the environment is friendly, when money is easy, when rates are low, banks essentially are starting to broaden out to clientele they normally don't serve. They're looking to lend to clientele they normally don't serve because the economic factors are in place to take more risk. And that environment is shifted right now. So what's happening? Institutions are reducing themselves back to a familiar customer base that they were designed to do business with. So when you think of a Chase Bank, an American Express, these are your heavy hitters. They are used to working with high net worth, high income individuals, people with bank, like real cash flow, established long-standing businesses, assets, entire financial assets that they can put up for collateral. Like they're not, even leaning on credit half the time with a lot of these types of clients. They're leaning on portfolios. They're lending against large stock portfolios and large real estate portfolios, existing businesses that already have great revenue and a great financial track record. So they're not on the same playing field that a lot of us are on, where we're literally just getting started. We are the riskiest clients in the marketplace. Those of us that are brand new, that still work W-2 jobs or depend on W-2 jobs and just trying business ventures on the side, or building brands and businesses or investment portfolios on the side, we are the riskiest clientele base for banks to generally lend to, especially big banks. Because again, many of us may not realize it, but there's hundreds of thousands, even millions of millionaires and high 6 and 7 figure earners out there that these banks have to work off of and keep their portfolios and their books growing off of without ever having to come to us for lending opportunities. So that basically means, as the thumbnail and the comment that I stuck on the thumbnail puts out there for you, or preludes for you, you have to go back to the financial institutions that were designed to serve you. Community banks, small, local, and regional banks, banks that are only in a few states, credit unions, they are literally built around everyday mom and pop working individuals. Credit unions, literally their business model is to be member owned and to take the excess capital that doesn't keep the lights on and keep the operations running and largely reinvest it back into their members. Literally the whole business model. That's the reason that they don't pay taxes as entities, as institutions, because the money is going back into the members, the owners. So you want to go back to these types of institutions as your primary access to capital, your primary option when you're looking to start, grow, or scale that small business or that business venture, that franchise opportunity, that small real estate portfolio you've been looking to start, or even just getting access to capital for like your primary residence. If you want to tap the equity on your home, one of my top pioneers and also a fellow YouTuber himself, the credit cousin, he just put that out on his channel, how he went to Navy Federal and got a home equity line of credit to go out there and start buying property or more property, rental property. So, you want to go back to the institutions that have rolled themselves back to their core customer base, which is going to be you and I, Main Street, the everyday individuals, the ones that aren't necessarily making, upper 6 and 7 figures a year in income or business revenue yet. Those of us that are still working, that, are trying ventures on the side or have operational businesses, but they're small, mom and pop scale operations. These institutions are designed to serve us, and that is where you're going to find your low to no doc programs still active. I found that in First Horizon Financial Institution in my local market here in Louisiana. They are in maybe a few states tops. They were a merger between Iberia Bank and some other bank, maybe that was called like First Horizon or something like that. They merged together, and they're still a community, slightly regional sized financial institution that is looking to start operating as a larger scale institution. I walked in, started a small banking relationship with them, got lucky and sat with a branch manager that had been there for years and was familiar with their products and services, and immediately started introducing me to their $50,000 no doc exposure program. So essentially, as long as you have a decent credit score and start a reasonable banking relationship with them, you can get access up to $50,000 in either a business credit cards or lines of credit with no documentation with a personal guarantor. So I walked right in and took advantage of that over the course of 2 or 3 months. Started a small personal and small business banking relationship with them. Few hundred over here, 1,000 over there. Let it sit, did some transactions, made some communications, and when it was time, when I was ready, I executed. I've accumulated $30,000 in excess capital from them that I don't necessarily need at the moment. But as I always preach on this channel, if you are out here taking the risk of going into business, building a brand, starting an investment portfolio, you have to be ready to have dry powder ready. You have to have these financial resources lined up when you don't need them, because that's the only time banks want to lend to you. So for me, that was First Horizon, but there's other financial institutions in your backyard that are doing the same thing, that are looking to still grow and expand amongst the familiar customer base. So final thoughts on this: protect your finances at all costs, protect your credit at all costs. None of these banks are going to be excited to see you with any negative items or with a ton of hard inquiries showing that you're credit thirsty or reaching overextended with credit. Make sure that you're keeping utilization low. Have a little bit in reserves and an emergency fund, some savings, which I shot a whole video about that. I can't wait to do the response on that. But you do want to have some excess cash available. You want to have the cash to start and grow these different relationships and plant the seedlings because this is what's going to get you in the door as a familiar client and making you more of a low risk client when you go to apply for funding with them versus walking in the door cold. Protect your finances, set up relationships, banking relationships, meet real people, meet real people in the branches, the bankers, the managers. These people are looking to do business. They'll let you know what's going on as long as you make a good presentation and show that you're a legitimate potential future client. And, plant those seeds and be patient. That's the name of the game right now. The economic system is going to shift and change. Things are moving faster. Go back to your roots. Go back to your community banks, your credit unions, your regionals, and some of your potential super regionals, your PNCs and Truists of the world, and tap those relationships. Chase Bank, if you got the credit, you got the cash flow, you got the collateral, the Chase Banks, the American Expresses, go for it. I have multiple personal and business credit cards with American Express. I have a solid relationship with them. Chase Bank's the same way. But at the end of the day, given your situation, you have to be mindful of where you're going to be received the best. Those larger institutions, if you're not already well established with them, are not going to be extremely friendly in this unstable environment. These local, small community banks and credit unions are designed to serve you even when things are turbulent. Go back to your home base. So comment down below. Let me know what your financial strategy is, your funding and lending strategy is to get access to capital. Let me know what that capital is for. Are you looking to get into or expand your real estate portfolio? Are you looking to buy a franchise and launch a franchise? Are you looking to just start your own personal business operation that you've been waiting to start, or grow an existing one? Comment down below and let me know where you're at. And let me know some of the financial institutions that are in your neck of the woods that are providing access to these financial tools and resources. To all my pioneers, welcome back. To my new viewers, welcome in. There'll be links in the description down below. I have expanded out to Instagram and slowly started to build out the platform and the brand out there. So follow me on Instagram. Let me know you're coming from the channel, and I'll make sure to give you a follow back. Other than that, you know how to support the channel. Like, comment, share, subscribe. You have the opportunity to follow other ways to support the channel down below. So make sure you do that so this channel can continue to reinvest and support you as well. Other than that, as always, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.